This metal is about to break the global economy. Every solar panel on every rooftop, every electric vehicle rolling off production lines, every 5G tower going up. They all need one thing: silver. And we're running out. Not in 50 years, not in a decade, right now. Here's what they're not telling you on CNBC. 3 of the world's largest solar manufacturers just secured 18-month silver contracts, 40% above spot price. That's not hedging, that's panic. Deutsche Bank sent an internal memo to clients last month. Leaked. The warning: physical silver markets could dislocate from paper pricing within 24 months. 2 weeks ago, India announced they're building a strategic silver reserve, not gold, silver. When central banks start hoarding an industrial metal, that's not preparation, that's panic. In the next 27 minutes, I'm going to prove to you with public data that silver just entered stage 3 of a 4-stage commodity crisis pattern. The same pattern that broke the global economy with oil in the 70s. The same pattern that sent uranium up 13 times in 24 months. The outcome? Mathematically inevitable. Every catastrophic commodity crisis in history happens when 3 conditions converge simultaneously. First, a supply shock you can't engineer around, not a temporary disruption. Geological constraint. The stuff isn't in the ground in quantities we need, or it takes a decade to extract. You cannot engineer around the periodic table. Second, demand surge driven by policy, not preference. This isn't consumers wanting more iPhones. This is governments mandating solar installations, banning internal combustion engines, rewiring entire energy grids. When demand is legislated, it doesn't respond to price. They'll pay anything. Third, monetary panic transforms the commodity into shelter. When faith in paper currencies erodes, when debt spirals out of control, investors flood tangible assets. Silver becomes money again. 5,000 years of monetary history doesn't disappear because we invented central banks. In 1973, oil had the first 2. Broke the global economy for a decade. Gas lines, double-digit inflation, real wages destroyed. Right now, silver has all 3. Simultaneously, for the first time in history. And unlike oil, where you could drill in Alaska, tap the North Sea, eventually develop alternatives, silver has no substitute for solar panels. None that works at scale. None that matches efficiency. You cannot build the green energy future without it. This isn't forecast. This is physics meeting economics, meeting geopolitics. The collision is already underway. Watch. This is not prediction. This is pattern recognition. There's a 4-stage mechanism that governs every commodity supercycle in recorded history. I'm going to prove it to you 5 times. 5 completely different commodities. 5 different eras. Different political systems. Different technologies. Same pattern. Same outcome. Oil 1970s. Rhodium 2021. Palladium 2000s. Uranium 2007. Silver 2011. Every single one followed the same 4 stages. Every single one. Silver is in stage 3 right now. Recognition of structural deficit. This stage lasts 12 to 24 months before stage 4 detonates. By minute 25, you will see this machine operating in real time. The inventories draining. The industrial users panic buying. The paper markets losing control. Everything I show you is public data. COMEX reports. USGS data. Solar forecasts from the IEA. Go verify it yourself. You'll see what I see. And once you see the pattern, you can't unsee it. 4 stages, every time. Stage 1. Abundance creates complacency. The resource is cheap, available. Nobody thinks it'll end. Exploration stops. Investment stops. The system assumes supply always meets demand. Total complacency. Duration, 10 to 30 years. Stage 2. Demand surges. Supply can't respond. A new use case emerges. Technology shift. Policy mandate. But mining takes years, decades to expand. Geology doesn't care about forecasts. Prices rise slowly at first. Markets don't panic. Yet. Duration, 3 to 7 years. Stage 3. Recognition of structural deficit. Markets realize supply won't catch up. Inventories drain visibly. Industrial users start stockpiling. Physical premiums expand. Paper markets begin losing control. This is the narrow window. The calm before stage 4. Duration, 12 to 24 months. We are here. Stage 4. Panic cascade. A trigger event. Major industrial player publicly announces they cannot source supply. Domino effect. Other firms panic buy. Governments secure strategic reserves. Investment demand explodes. Paper markets break. Exchanges change rules. Force cash settlement. Restrict delivery. Price doesn't rise steadily. It gaps. $50, $75, $100. Violent dislocations. Duration. 3 to 18 months. The pattern is invisible until you see it. Then, it's everywhere. I'm going to show you this pattern operating across 5 different commodities. When you see it 5 times, you understand. This isn't speculation. This is how commodity markets break. Stage 3, signals. Watch for these. Inventory velocity. Weeks of consumption remaining. Under 4 weeks, critical. Silver approaching that now. Futures curve. Contango, normal. Backwardation stressed. Spot higher than futures means physical shortage. Silver flashed backwardation 3 times 2024. Warning shot. Physical premiums. Normal 3 to 5%. Warning 8 to 12. Panic 20 plus. American Eagle's 18 to 25% over spot right now. Sustained. Industrial behavior. Just-in-time becomes 12-month forward contracts. Premium prices accepted. Solar manufacturers locking 18-month supply now. That's stage 3. Paper physical gap. 100 ounces paper for every 1 physical. Delivery requests spike. Gap explodes. Paper surrenders. These signals don't lie. They telegraph stage 4 before it detonates. Window closing. Oil. 1970s. Stage 1. 1945 to 1970. Oil, $3 a barrel. Gasoline, 30 cents. Entire post-war boom ran on cheap energy. Suburbanization. Mass car ownership. Nobody questioned it. Abundance total. Stage 2. 1970. U.S. oil production peaked. Hubbard was right. Demand exploding. Europe rebuilding. American suburbs sprawling. But new supply? North Sea wouldn't produce until late 70s. America became net importer for first time. Supply inelastic. Demand exponential. Stage 3. October 1973. Yom Kippur War. OPEC embargo. Price quadrupled in weeks. Not just the embargo, the brutal realization that cheap energy was over. Gas lines formed. Production slowed. Recognition phase complete. Stage 4. 1973 to 1980. $3 to $35 a barrel. 10 times in a decade. Inflation ravaged economies. Double-digit inflation. Interest rates hit 20%. Central banks lost control. Real wages declined for an entire generation. Government tried price controls. Made it worse. Created black markets. Shortages deepened. The most powerful country on Earth. Reserve currency. Largest military. Brought to its knees by a supply shock. Power doesn't exempt you from geology. Physics always wins. Pattern confirmed. Rhodium. 2020 to 2021. This one you remember. Happened during COVID. Stage 1. Rhodium, $6,000 an ounce in 2019. Cheap. Boring. Ignored. Stage 2. Emission standards tightened globally. Catalytic converters needed more. But rhodium? 80% from South Africa. Single point of failure. Stage 3. COVID lockdowns shut South African mines. Supply shock. Immediate. Physical market decoupled from paper pricing. Users couldn't source metal. Recognition. Instant. Stage 4. $6,000 to $29,000 in 18 months. 5 times. Automakers couldn't get enough. Production lines delayed. Eventually substituted platinum. Massive cost. Efficiency loss. Still paid it because no choice. Lesson. Geopolitical concentration plus supply disruption equals price violence. And rhodium had alternatives. Platinum worked. Expensive, but it worked. Silver? No alternative for solar panels that works at scale. None. Pattern confirmed. Palladium. 2000s. The one that exposed paper market manipulation. Stage 1. 1990s. Palladium cheap. Abundant seeming. Nobody cared. Stage 2. Early 2000s. Emissions regulations tightened. Palladium became preferred over platinum for catalytic converters. Problem. Palladium is byproduct. 70% comes from Russia. Can't just mine more. Supply structurally inelastic. Stage 3. 2015 to 2019. 8 consecutive years of deficit. Russia controlled 40% of supply. No incentive to flood market. Inventories depleted. Paper contracts tried to suppress price. Physical markets said no. Stage 4. $500 an ounce, 2016. $3,000, 2020, 6 times in 4 years. NYMEX changed contract specifications mid-crisis. Automakers forced to substitute platinum at massive cost. When physical supply can't meet industrial demand, paper markets eventually surrender. Price is the only adjustment mechanism, and it's never smooth, always violent. Pattern confirmed. Uranium. 2005 to 2007. Fastest commodity move in modern history. Stage 1. 1990s to 2004. Post-Chernobyl nuclear fears. Uranium $10 per pound. Dirt cheap. Mines closing. Exploration dead. Stage 2. 2005. China announced 30 new reactors. India followed with massive nuclear build-out. Demand surge. Policy-driven. Mandated by governments. Doesn't respond to price. Stage 3. June 2006. Cigar Lake mine flooded. Canada. World's largest undeveloped uranium deposit, gone overnight. Expected to supply 15% of global demand. Market realized. No supply buffer exists. Recognition immediate. Stage 4. 2006 to 2007. $10 per pound to $137. 13 times in 24 months. Parabolic. Utilities panic buying. Signing any contract at any price. Spot market essentially froze. No sellers. Junior mining stocks, 10 times, 20 times, 50 times. Companies with no production, just land claims, went vertical. Current status. Uranium stabilized around $80 to $100 per pound. Never went back to 10. Permanently higher plateau. Lesson. Policy-driven demand plus concentrated supply plus single supply shock equals parabolic move. All three conditions present. Silver has all three building simultaneously right now. Pattern confirmed. Silver. 2011. The warning shot. The dress rehearsal. Context. Post-2008 financial crisis. Quantitative easing infinity. Dollar collapsing. Investors fleeing fiat currencies. Stage 3 signals everywhere. SLV ETF couldn't source physical silver fast enough. COMEX inventories draining. Retail investors flooding in. The spike. $18 to $49 an ounce in 6 months. Nearly 3 times. May 1st, 2011. CME raised margin requirements 5 times in 8 days. Forced liquidation of leveraged positions. Price crashed to 26 within weeks. Paper market reasserted control. Temporarily. Here's what's different now. 2011. Only monetary demand. Investors fleeing fiat. That's it. 2025. Industrial demand plus monetary demand. Simultaneously. 2011. Solar consumed 35 million ounces annually. 2025. Solar consuming 200 million ounces annually. 2011. No structural supply deficit, just monetary panic. 2025. Structural multi-year supply deficit, plus monetary panic building. 2011. They could suppress it, raise margins, force selling. 2025. Industrial users won't sell, can't sell. They need the metal for production. Margin requirements are relevant when you're taking delivery. Last time, silver only had one bid, the monetary bid. This time, it has two, industrial and monetary. When both bids activate together, no amount of paper manipulation contains it. Pattern confirmed. 5 times. Silver isn't just another commodity. It's irreplaceable in the technology governments have mandated. Solar panels. Crystalline silicon, current generation, 15 to 20 grams silver per panel. Doesn't sound like much. Scale it. Average residential system, 20 panels, 400 grams total. Utility scale solar farm 100 megawatts, 2 million ounces. Global solar installations 2024, 400 gigawatts minimum. Math, 400 gigawatts times 20 grams per watt equals 200 million ounces annually, just for solar. Electric vehicles. Gas car uses 15 to 30 grams silver. Electric vehicle uses 25 to 50 grams. Nearly double, plus charging infrastructure. Every fast charger, 1 to 3 kilograms additional silver. 2024, 14 million EVs sold globally. 2030 target, 40 million EVs annually. Math, 26 million additional EVs times 35 grams average equals 29 million ounces additional demand every year. Compounding. 5G infrastructure. Every base station. 3 to 5 kilograms silver. Global rollout. 15 million base stations by 2030. Medical devices. Water purification. Consumer electronics. Steady 200 million ounces annually. Added up. Industrial silver demand, 1 billion ounces per year, growing. Global mine production, 880 million ounces, peak in 2015. Now flat, declining in some regions. The math doesn't work. Here's the trap. Silver manufacturers will pay $50 an ounce, 75, 100. Why? Silver equals 6% of panel cost. Even if silver triples, panel cost only rises 12%. Government subsidies absorb the increase. Industrial demand doesn't respond to price when the technology is mandated by law. That's the floor. The inelastic bid. And it's rising. 5,000 years of monetary history doesn't disappear because central banks print paper. Silver, oldest form of money, before gold in many civilizations. Roman denarius, Spanish dollar, U.S. silver standard until 1964. More transaction history than gold. Gold for the wealthy. Silver for commerce. Silver is the people's money. Always has been. The silver-gold ratio, currently 85 to 1. 85 ounces of silver buys 1 ounce of gold. Historical average over 2,000 years, 15 to 1. Modern 50-year average, 55 to 1. Current ratio, extreme. Historically distorted. Gold hitting all-time highs. 2650 plus in 2024. Central banks buying record amounts. 1,037 tons in 2023. Silver lagging dramatically. Historical pattern. When ratio is extreme, mean reversion is violent. 1979 to 80. Ratio went from 40 to 1 to 15 to 1 as silver exploded. The poor man's gold effect. Average investor can't buy gold at $26.50 per ounce. Silver at $31? Accessible. When monetary panic spreads to retail, silver gets the flood. 1 ounce gold equals 85 ounces silver. That's leverage in ratio compression. Current monetary environment. Global debt, 307 trillion. 356% of GDP. Negative real rates. Currency debasement accelerating. When people lose faith in paper, they return to what worked for 5,000 years. Now watch what happens when these two forces activate simultaneously. Industrial demand sets rising price floor. Inelastic. Must have it. Rising prices trigger monetary demand. Investors notice. Monetary demand accelerates price rise. Higher prices trigger industrial panic buying. Fear of even higher prices. Cycle accelerates. Exponentially. You can liquidate speculators. Raise margins. Force selling. You cannot liquidate industrial necessity. When solar panic meets currency crisis, price doesn't adjust. It dislocates. Can't just mine more silver. Not how it works. 70% byproduct. Zinc. Lead. Copper mining. Silver comes with it. Only 30% from primary silver mines. You can't mine more silver. You mine zinc. Hope silver tags along. Base metal prices flat. Zinc. Lead. Copper. Not profitable to expand. No base metal expansion equals no byproduct silver. Math is brutal. Primary silver mines need $23 to $27 per ounce. Current price, $31. Marginal. Barely worth it. Mining capex down 40% from 2012. Silver exploration, multi-decade lows. 10 years, flat prices killed investment. Survival mode, not growth mode. Timeline? Find deposit, 2 to 3 years. Prove reserves, 2 to 3 years. Permitting, 3 to 5 years. Construction, 2 to 3 years. 7 to 10 years minimum. Start today. New supply arrives, 2032 to 35. Deficit is now. Major mines depleting. Mexico, number 1. Production declining. Cannington, Australia. Grades down 40%. No major discoveries since 2015. Lower quality ore. More energy. Higher cost. Less silver. Easy silver. Gone. Not just finding silver. Quality collapsing. Ore grades. 1990s. 250 grams per ton. 2010s. 120. Current. 80 to 100. Declining 3 to 5% annually. Process 2 to 3 times more rock for same silver. Energy costs up. Waste rock up. Economics worse. The energy silver paradox. Mining needs diesel. Electricity. Fossil fuels. Green transition needs silver. Producing silver needs fossil fuels. Lower grades equal more energy per ounce. Equal higher carbon cost. The irony. Need fossil fuels to mine silver for solar panels to replace fossil fuels. Geology doesn't care about climate goals. 80% of silver comes from countries that are either unstable or strategic rivals. Top producers, 2023. Mexico, 190 million ounces, 23% global. Cartel violence, mining disruptions. China, 110 million ounces, 13%. Keeping more domestically. Potential export controls. Peru, 105 million ounces, 13%. Political instability. Indigenous protests shut mines. Russia, 40 million ounces, 5%. Western sanctions. Strategic rival. Chile, 40 million ounces, 5%. Water scarcity. Social unrest. Top 5 equals 59% of global supply. All have significant political risk. The China factor. Second largest producer. Also largest consumer. 2020. China exported silver. 2024. China net importer. Domestic solar and EV production consuming local supply. Risk. China could restrict exports anytime. Precedent. Rare earths 2010. The West is dependent on potentially hostile nations for a metal it needs for energy transition. This is how energy transitions get derailed by geopolitics. The warning is flashing red. Nobody's watching. COMEX registered silver inventory. January 2020, 331 million ounces. December 2024, 52 million ounces. 84%. Gone in 4 years. Rate of decline accelerated. Faster in 2024 than 2023. What registered means. Eligible silver. Stored in COMEX vaults, but not available for delivery. Registered silver. Available for delivery to settle futures contracts. Only registered matters for physical settlement. 52 million ounces. Global silver consumption. 1 billion ounces annually. Math. 52 divided by 1,000 equals 5.2% of annual consumption. Time coverage. 52 million divided by 1 billion divided by 52 weeks equals 2.7 weeks. Less than 3 weeks of global consumption sitting in exchanges. That's not inventory. That's fumes. Other exchanges. LBMA London vaults. Data less transparent but reported drawdowns. Shanghai Gold Exchange. Silver inventories declining. Combined visible inventories. Lowest in decades relative to consumption. Historical context. 2011 silver spike. COMEX had over 100 million ounces when price hit $49. Current, half that level. Consumption, 40% higher. Half the inventory buffer. 40% more demand. Do the math. The withdrawal acceleration. 2022. Average 3 million ounces per month withdrawn. 2023, 5 million per month. 2024, 8 million per month. Trend. Large withdrawals spiking around contract expiry dates. Someone is taking physical delivery. Consistently, aggressively. Industrial users, solar manufacturers, they see what's coming. Paper price says $31. Physical market screaming something different. Premium expansion, American Silver Eagles. 2019. 8 to 10% premium over spot. Normal. 2020 COVID. Premium spiked to 30% plus. Temporary panic. 2021 to 22. Settled to 12 to 15%. Elevated but stable. 2024. 18 to 25% premiums. Sustained, not temporary. Sustained stress. Premiums higher now than before 2020 panic. And staying there. Delivery delays extending. Major dealers reporting 2 to 4 week delays on standard products. Custom orders, 6 to 8 weeks. 1,000 ounce bars from refineries, 8 to 12 week wait times. 2019 comparison. Same products shipped within 3 to 5 days. When you can't get physical immediately at quoted price, paper price is a lie. Refinery bottlenecks. Refineries running at capacity. Wait times for new production slots, 12 to 16 weeks. Not a capacity issue. Source metal issue. Refineries can't get enough raw silver to process. Backwardation incidents. December 2023. Brief backwardation in silver futures. March 2024. Backwardation 3 consecutive days. Backwardation means spot price higher than futures. Abnormal. Signals physical shortage. Carrying costs inverted. Normal markets, you pay more for future delivery. Storage costs. Financing costs. When spot is more expensive, someone needs it now. Can't wait. The arbitrage that isn't. Theoretical arbitrage. Buy paper silver cheap. Demand delivery. Sell physical expensive. Pocket the spread. Reality. Can't get delivery quickly enough. Minimums too high. Spread too narrow after costs. The convergence mechanism between paper and physical is breaking. Coin mints. U.S. Mint rationing Silver Eagle production to dealers. Royal Canadian Mint allocation systems. Perth Mint delivery delays on monster boxes. When government mints can't keep up with retail demand, what happens when institutional demand arrives? Watch what they're doing, not what they're saying. Forward contract activity. Solar manufacturers securing 12 to 18-month forward contracts. Unusual. Normal practice. 3 to 6 month rolling contracts. Premium paid for longer contracts. 15 to 20% above spot. They're locking in supply at premium prices. That's not hedging. That's panic. Stockpiling evidence. Silver Institute reports industrial users building 6 to 12-month inventory buffers. Historical norm. 30 to 60 days inventory. Working capital tied up. Expensive. Doing it anyway. When CFOs accept higher inventory costs, they're paying insurance against supply disruption. Substitute research acceleration. Major solar companies funding silver reduction R&D. Millions invested in copper paste. Aluminum alternatives. Result? Nothing viable at scale yet. The fact they're desperately researching alternatives tells you everything about their supply fears. Quiet diplomacy. Reports of major manufacturers meeting mining companies directly. Offtake agreements at above market prices discussed. Bypassing normal supply chain. Extreme measure. When buyers go directly to miners, spot market has already failed them. Automotive sector. EV manufacturers less vocal, but similar behavior. Tesla. BYD. Volkswagen. Quietly securing silver supplies. Every EV is a silver consumption machine, scaling to millions of units. The industrial bid is activating right now. Stage 4 doesn't start gradually. Starts with one event. 4 most likely triggers. Trigger 1. Industrial supply failure. Major solar manufacturer publicly announces cannot fulfill orders due to silver sourcing. Longi. Jinko Solar. Trina. Solar installation projects delayed. Stock price collapses. Panic spreads. If they can't get silver, can anyone? Trigger 2. COMEX rule change. Registered inventory drops below 30 million ounces. Exchange raises margin requirements 3 times overnight. Or worse, forces cash settlement. Restricts physical delivery. Precedent. They've done it before. Silver, 2011. Palladium, 2020. Market loses faith in paper contracts. Trigger 3. Geopolitical supply shock. China announces export controls on silver, following rare earth playbook. Mexico mining disruptions escalate. Cartel violence. Peru political crisis closes major mines. Russia leverages silver supply for sanctions relief. Pick your crisis. Any one triggers cascade. Trigger 4. Monetary crisis acceleration. Currency crisis in major economy. Japan. UK. EU instability. Flight to hard assets intensifies. Retail investors flood silver. More accessible than gold. ETFs can't source physical to back new shares. When paper money fails, people remember metal. You need just one of these 4. Odds of none happening in next 24 months? Close to 0. Here's how it unfolds. Not years. Weeks. Day 1. News breaks. Trigger event. Silver futures gap up 15% at open. Trading halts triggered. Social media explodes. Week 1. Industrial users panic buy at any price. Physical premiums spike to 40–50% overnight. Coin dealers sell out inventory in 48 hours. COMEX inventory drains 10 million ounces in 5 days. Record. Week 2 to 4. Government response makes it worse. Calls for market manipulation investigations. Proposals for export controls. Some countries restrict silver exports. Result? Accelerates hoarding. Worsens shortage. Month 2. Paper market breaking. Futures contracts increasingly settled in cash. Forced. Spread between paper and physical widens to 60% plus. ETFs suspended. Can't get physical for new shares. Paper market lost control entirely. Month 3. Price dislocation. Silver. $31 to $65 to $95 in 90 days. Not steady climb. Gaps every week. Circuit breakers triggered repeatedly. Mining stocks up 300 to 500%, but can't deliver metal for years. Month 6. New equilibrium. Price settles around $80 to $120. Depends on trigger severity. Physical always trades at premium to paper. Solar installations slowed, waiting for cost adjustment. Permanently higher cost structure accepted. This isn't prediction. This is how commodity crises unfold every time. Only variable is speed. You're thinking, interesting, but how does this affect me? Connect the dots. Your home solar dreams. 2024. Average residential system costs $18,000 after tax credit. After silver spike, same system. Costs $25,000 to $30,000. 30% tax credit doesn't matter if base cost jumps 40%. Your ROI calculation just broke. Your electronics, phones, laptops, tablets, all need silver. Supply shortage equals component shortage equals product delays. Prices rise across consumer electronics. Remember chip shortage? Now imagine that for a metal with no substitute. Your energy bills. Grid upgrades delayed. Solar installations delayed. Silver needed for both. Green energy transition stalls. Continued reliance on fossil fuels equals higher prices. Transition was supposed to lower costs. Can't transition without silver. Your investment portfolio. Stock portfolios. Tech, solar, automotive sectors hit hard. Bonds. If inflation spikes, commodity-driven, bond values crash. Typical 60-40 allocation? Exposed. The 60-40 portfolio wasn't built for commodity supercycles. Your currency's purchasing power. Commodity inflation historically precedes general inflation. Central banks behind the curve. Always are. Real interest rates negative equals savings eroded. This isn't abstract macroeconomics. This is your grocery bill, gas tank, rent. This hits everyone. Question is, positioned or exposed? You're smart. You're thinking of counter-arguments. Technology will reduce silver usage. Reality. TOPCon panels use 20% more silver than PERC. HJT heterojunction uses 30% more. Why? Higher efficiency requires better conductivity equals more silver. Even if reduction tech works, takes 5 to 7 years to scale. Innovation is slow. Deficit is fast. Can't R&D your way out of geology. Recycling will close the gap. Current recovery rate. 15 to 20% from e-waste. Solar panels, 25 to 30-year lifespan. Silver locked away until 2049. Economics, only profitable to recycle above $40 per ounce. Scale, even 100% recycling equals 180 million ounces versus 1 billion ounces demand. Recycling is a 2040s solution. Problem is 2025. This is hype to pump prices. Response, I don't sell silver. Check the data yourself. Institutional behavior can't be explained by retail hype. Deutsche Bank, India government. Solar manufacturers, they're stockpiling. That's not hype. That's information. Follow the money. Large players are preparing. Government intervention will cap prices. History. Price controls always fail. Nixon, 71. Oil, 70s. Create shortages. Black markets. Make problems worse. Can't legislate geology. Governments can control paper prices temporarily. Cannot create physical silver that doesn't exist. You've now seen the pattern 5 times. 5 different commodities. 5 different eras. Same 4 stages. Same outcome. Oil, 73. Rhodium, 21. Palladium, 2000s. Uranium, 2007. Silver, 2011. Every single one proved the pattern. Abundance. Inelastic supply. Recognition. Panic. Silver is in stage 3 right now. You've seen the evidence. COMEX inventories down 84%. Physical premium sustained at 20% plus. Industrial users forward buying at premium prices. Futures curve flashing backwardation. Governments building strategic reserves. Stage 3. Recognition of structural deficit. 12 to 24 months before stage 4 detonates. The 3 converging forces. Supply shock you can't engineer around. Demand surge driven by policy, not price. Monetary panic building as currencies debase. All 3. Simultaneously, for first time in history, when solar panic meets currency crisis, when industrial necessity meets monetary flight, when the inelastic bid meets the elastic bid, price doesn't adjust. It dislocates. This isn't forecast. This is physics. This is geology. This is math. Consumption exceeds production. Inventories depleted. Price must rise. Only possible outcome. I'm not telling you what to do. I'm showing you what's coming. Go verify this yourself. COMEX inventory data. CME Group website. Free. Public. USGS mineral commodity summaries. Government data. IEA solar forecasts. Free summary available. Physical premiums. Check APMEX. SD bullion. Right now. It's all public. All verifiable. Spend 2 hours researching. If I'm wrong, you'll know. If I'm right, you're ahead of 99% of people. Pattern recognition isn't prediction. It's seeing what's already in motion. The machine is running. Inventories draining. Demand accelerating. Supply constrained. The largest wealth transfers happen when asymmetric information becomes symmetric. Right now, you're on the informed side. Most people won't see this until CNBC covers it. When CNBC covers it, you're in stage 4. Too late. The question isn't if, it's when. And when determines if you're positioned or exposed. Subscribe. Turn on notifications. Share this with someone who needs to see it. What comes next is the largest commodity wealth transfer in 50 years. Don't be everyone else.